So I guess I'm doing the fun part of the evening, the mid-year outlook. Not the easy part, but maybe the fun part. So I'll go over this, and I kind of wanted to bring us back to some basics. So we utilize a framework to get a weight of evidence approach to try to stay balanced in terms of where we see the market and what we believe the market will do. We get a lot of our data from Ned Davis Research. I'll just call it NDR. They're a world-renowned investment research firm. They're known for their objective, data-driven insight, and we review their information as an investment committee and make decisions as a committee. But there's 4 pillars of kind of the investment process, and I just want to go over that real quick. There's macro and fundamental. And that really tells us how the market should be acting. I say should be acting because macro and fundamental are more bigger pictures. There's more slow moving indicators, and the market can decouple from the fundamentals and from the macros from a considerable period of time overall. Macros are like fiscal policy, monetary policy, the Fed, fundamentals being more earnings. And then there's technical and sentiment. And those are the other 2 pillars. And that's really like the pulse of the market. And that tells us really why the market is acting or how the market is acting overall. So technicals are things like volatility, price, trend, momentum, volume, things of that nature. And then sentiment is really like crowd behavior and investor psychology. And so those are more faster triggers overall. But we need to be conscious of all of the pillars and take a kind of a balanced approach. And so every single slide I'm going to show you, I'm going to point out kind of what pillar that we're looking at. So I showed this slide a couple times when I presented in the past, and I think it's good to review just from the basis that this is a normal stock market and economic cycle. And it's very similar to what's happening right now, except for the fact the time of recession, which we had was COVID, was very, very short overall. But a typical economic cycle is we have a bear market that goes into a recession essentially, and the market gets oversold, which is from extreme pessimism. After that recession, because expectations are so low coming out of that, we have a post-recession bull, which is a multiple expansion and extended mean reversion. This can last from 1 to 2 years generally. And just like most of the time, we get either overly pessimistic or overly optimistic. In this case, in the end of 2021, there was excessive optimism. Market was ignoring some signals overall. And we had a bear market in 2022. A bear market would be defined as just going down 20%. So that was a bear market. But there's 2 big differences in bear markets. There's a non-recessionary bear market and a recessionary bear market. Recessionary bear markets last longer and are worse. Non-recessionary bear markets aren't as bad in magnitude. And if this is a part of a longer term bull market, we consider that a non-recession echo bear, where eventually we get to a point where the market gets oversold again and extreme pessimism is very, very high. This is in your head, September, October of last year. But then things start to rebound, and this is the longer part of it, is a post-echo bull. So if we can avoid up until a recession, we're in this post-echo bull essentially, coming back 20%. It's a shorter mean reversion. It's not as quick in terms of a multiple expansion, but this is your longest time period that can last generally 6 months to 5 years. So we're somewhere in here at this point in time following an economic cycle. So I'm going to start with technicals. So technicals, again, are more faster moving indicators. And obviously we're coming off of a low in September, October, and we're kind of at, we're at our year high right now, and the momentum is favorable. And you could say, well, since we're up 10% plus in the first half, is it going to continue or is it not going to continue? So I looked at all the times where the market was up 10% in the first half, and these are all the instances. And surprisingly, in the second half, that doesn't mean the momentum just goes away. And actually, the median in the second half is actually up 9.7%, which is right here. The mean is 6%, so still both positive, and that's happened 75% of the time. It hasn't happened all the time, but most of the time when the momentum is going this way, it sticks with us, for a while. This is the second best first half, I think, this whole century. So it has been pretty significant overall. However, you may look at some stocks that you have and what's going on. The rally has been really narrow and considerably narrow until June. Generally, this is the percentage of stocks that outperform the S&P 500 over the past 3 months. The median is 50%. That makes sense, right? Usually 50% of the stocks are outperforming and 50% are underperforming. Well, only in June, only 20% of the stocks in the S&P were actually outperforming the S&P 500. So that was a really narrow market. But what we saw in June was a broadening out. Other stocks came to the party essentially, and you can see that a lot more came up in terms of beating the S&P 500. I mean, this rally has been mostly concentrated in mega tech, mega cap tech overall, which did terrible last year, but they've had some mean reversion this year. They've had some AI influence. So there's been things that have kind of bolstered that. The banking crisis actually helped mega cap tech, because the market thought, well, with this banking crisis, the Fed may not have to raise interest rates anymore. That's yet to be determined. I'll talk about that. But more are joining the party essentially. Now the concentration of the S&P 500 is getting pretty high as well. So about 30% of the S&P 500 is made up of the top 10 stocks overall. Now, this doesn't mean that it's a rally killer. What it means generally is when the market is this narrow for the first half, if the second half rally continues, it needs to broaden out even more than it has broadened out already. So last quarter, just to give you an idea of what went on, you can see large cap growth. So that's mostly tech, there's communication services in there, up 14%. Large cap value is only up 2.6%. And mid cap and small cap, greatly, everyone was positive, but large cap growth was definitely the bright spot overall. And so we looked historically when there has been this narrow leadership. Generally, there's just a mean reversion where value starts to catch up with growth, and it may not outperform growth completely, but value starts to catch up. And we do see kind of a technical play of mid and small cap definitely catching up relative to large caps overall. If there's confidence in the rally, money looks for not the ones that have already done well, it looks for the ones that need to catch up, and that's why this occurs. So this is more of a secondary indicator, but this is a cycle composite. And I'll do my best to explain. Some of these charts can get a little technical. The blue line is just a cycle composite based on what a normal year would be from a 1-year basis, a 4-year presidential cycle basis. Pre-election year historically is the best year in terms of market returns. Election year is your second best year in terms of market returns. So we're in a pre-election year, and then a 10-year cycle. So the blue line does good until July, then it kind of goes sideways and gets maybe a little year-end rally. The dotted orange line is what we've done so far. So we could expect the rally to kind of continue just on a cycle composite basis, for a few more months, and then it's going to get choppy probably, but it looks like at least the trend is to chop higher. At this point, we've pushed out most of our recessionary models and indicators out to 2024 at this point. All right, so I'll move on to fundamentals. So again, fundamentals, one of the pillars, again, it's more slower moving. It can decouple from the market. Technicals, definitely a highly favorable environment right now, as what the trend is. Fundamentals, more of a mixed bag. Oops, too fast. So don't look at this blue line. That's just the S&P. Look at these orange rectangles, if you will. So this is the percentage of companies with positive earnings surprises. Most of the time we're in the 70% range. But you can see it about 2021 when I was talking about being overly optimistic. Well, analysts can get overly optimistic as well, and expectations were pretty high. And quarter after quarter after quarter, almost kind of consecutively, companies were not beating having positive earnings surprises as much as they normally would have, or it was on the decline. And this last quarter, we actually jumped up quite a bit in terms of our earnings surprises. So I think expectations are getting more in line with the market overall, which is a good thing. From just a fundamental valuation standpoint, this is price over earnings, a forward 1 year price over earnings. Historically, the mean's around 15.3. We're more like 18.7. This is a trailing price to operating. We're above the mean. And this is a trailing. We're above the mean as well. So stocks are still not cheap. They're expensive. They're a little bit on the more expensive side, but we do have some trend going with us. And one thing that would make these charts look better is obviously earnings continue to go up and we avoid, a recession, as well as what helps justify higher valuations is the risk-free rate of return, which is like, what could you get in a money market or treasuries and so forth. And when treasuries are real low, when interest rates are near zero, we can justify much higher valuations. And that's why tech stocks who have higher valuations move a lot more on, is the Fed going to stop? Is the Fed going to continue kind of thing? So this is I don't know who coined these phrases, CNBC to make you watch more, or whoever. So Tina replaces Tara. So Tina is there is no alternative, and they're talking about the stock market. This is when interest rates were at zero. They said that basically there is no alternative to stocks because you don't earn any money sitting in cash. You got to invest in the stock market. Well, now we have reasonable alternatives. So it's Tara. There are reasonable alternatives. And the reasonable alternative is a 3-month treasury bill is paying almost 5.5%. The S&P earnings yield, which is just their earnings per share divided by their price per share, is only at 4.5%. So the actual yield on a treasury bill is higher than the earnings yield of the S&P 500. And you can see this is not a normal occurrence. So only two things could make this better: what, short-term rates go down, or earnings go up, or a combination of the two, which would be really, really nice. But this, I think, is what gives us a little bit of a ceiling on the market, because there are reasonable alternatives. And there has been a lot of money to move into money markets, overall, that probably was not meant to stay in money markets forever. So eventually it's going to make its way back into some type of riskier asset class when yields are maybe not as high there. All right, cruising along. Macro. Now, macro gets the most, I would say, recognition. People like to talk about macro the most. From a client perspective, from CNBC, like that's, well, when does this recession happen? What's happening with the Fed? What's going on with inflation? But they're not like just immediate signals overall. Again, it's bigger picture and slower moving. And I would say macro is getting a little bit better. This is our recession probability model. And this is, just follow along with me. When the orange line is above 70, that we believe there's a high probability of a recession. And the recession, which is usually called after the fact, is these areas in gray. Every single time this orange line got above here, we had a recession since this model's been going on. Well, here we are out here where we had really a high probability, but we've come all the way down to 50% probability, or much more in the neutral zone overall. And we haven't had a recession. We talked about it all year long last year. Didn't have a recession. We don't believe we're on the cusp of a recession right now either. But historically, when we've gotten there, this has happened. So maybe this is an indicator is telling us the right, or maybe this is an anomaly based on the weirdness of COVID and all the COVID stimulus and the intense inflation from the supply side, and the Fed tightening and so forth. But historically, when this recession probability model is falling, that's when we get the best returns. So we came out of the high zone and here, and average return is 19%, and that's pretty much where we're at. And in this area, we can also get good returns as long as this continues to fall, because theoretically, if it continues to fall, that just means economic news is getting better. Our economic timing model also takes a bunch of different economic indicators. I think it's about 27 different economic indicators, and gives us the severity of a potential recession. You know, if when we do go into a recession, we were in this mild recession mode, and economic indicators have been getting better. We are now in a slow growth mode, and slow growth mode right here is about 2.2%, and that's on GDP. So we want slow growth is actually what we want. You would think, oh, well, we want strong growth. If we get too much strong growth, inflation comes back, and then the Fed's going to bug us some more. So, but if we get slow growth while inflation comes down and the Fed can just back off a little bit, that's the needle that we need to thread. People have been talking about credit conditions, and I mean, our economy functions on credit, especially since the banking issues that we had in March. Like, is credit going to fall apart? Well, credit actually has been on, it's kind of bottomed out here since March, and has actually been getting better, both on the business standpoint and the consumer credit standpoint. And this is kind of more in line with where we were at throughout the bull market from 2010 to 2020. So credit conditions right now are doing perfectly fine. You would think with all the Fed raising interest rates, like, well, this tightening has got to have an effect on the economy. But what we didn't realize, or maybe what a lot of people don't realize, is we've been in a policy easing scenario in 2023. So this blue line, when it's above this dotted line, says, it's fiscal policy easing and fiscal policy tightening. And it's been on a major incline since 2022. And the major reason here is 8.7% increase in Social Security, which happens after the fact. It takes into consideration what happened a year ago, then gets you your Social Security increase. So we pretty much know kind of roughly what your Social Security increase will be for next year, because it goes from October to October, and the prediction is about 3%. So some of this policy easing with just Social Security will be waning off a little bit, but this was a big boost. Even with higher interest rates, that was a big boost fiscally for the economy. So we talked about inflation in every single webinar last year, June, July. We said that we think we're on the peak of inflation and we're going to be coming down from here. And so far we've been right, and it's continuously come down. Since that point in time, maybe a little bit stickier than everybody wants, but the trajectory has definitely been down. And we still believe we're in a low inflationary pressure environment. When this blue line is down here, we consider low inflationary pressure. That's when we have the best market returns. When it's below zero, we have the best market returns per annum. Now, how long will this last? It looks like there'll be at least a couple more months of disinflation. CPI has come down considerably, right? It says 4, now we're at 3. PCE, which is a broader index, is a little bit higher. I think it's like 4.5, 4.6% overall. So there's still some room to come down there, but that has housing and energy and so forth. But it's come down pretty significantly. But eventually, the base effects from going year over year, where last year was really high, which makes the numbers look favorable, will start to even out. So some of that base effects will kind of erode. So at least a couple more months, we believe, of disinflation. Unless we slip back into an expansion and the economy reaccelerates, then that could actually put upward pressure on inflation. But this is the thing that I think, gives us the big pause. Like, if we do go into recession, more than likely it'll be a Fed-induced recession, the rate of interest rate change. And again, we don't see a recession. Our recessionary models don't show till next year. The good news is the percent of central banks that have increased rates within the last 8 weeks has come down considerably, meaning not as many banks are increasing rates. But the bad news is this is the percent whose last rate change was an increase. No one's cutting rates. So I think China cut rates once, but can't think of anyone else who cut rates. So no one else is cutting rates. And so, more than likely, the Fed may have a rate hike or two, unless the inflation data comes out really favorable. Maybe they'll skip July. Yesterday or the day before was a really good number. PPI was a really, really good number. Maybe they'll hit the pause brakes additionally there. But we haven't seen any kind of boost from decreasing interest rates. And this is my chart of the day, if you will, because this is the most difficult chart to understand. So I think I've shown this before, but just bear with me. So this is the real rate on the side here. And the real rate is taking the Fed funds rate, which is 5.25, minus core PCE inflation, which is 4.6. So really we're at like 0.6 or 0.7. This chart's a little bit old, but so all of these are tightening cycles and when they ended. And most tightening cycles, meaning when interest rates go up, ended in this sufficiently restrictive economically section. We are probably just above this sufficiently restrictive financial section. And we need to get up to here, which is at least another percent or 1.5% of real rates. So there's only two ways to get there. It's either the Fed funds rate goes up or the core PCE inflation goes down. And I think it's going to be maybe a combination, a little bit of them both to get us there. But there might be a little bit more work to do to get to this sufficiently restrictive economically versus sufficiently restrictive financially. But I would say, at least from our perspective, most of the rate hikes are behind us. All right, sentiment. I feel like this is a one that is quite often overlooked. It's the one that feels the most different to probably maybe how you feel or how I feel, because it takes crowd behavior and it looks for inflection points and then takes a contrarian position. So let me explain this a little bit. So this is a short-term sentiment indicator. When there's extreme pessimism, that means a lot of people have already sold, there's money on the sidelines. That is what can produce potentially good rallies on the upside. So when everyone is pessimistic, that means we have the opportunity for some good rallies. When everyone is optimistic, that's when we have the potential for larger corrections, where a lot of people have bought in, there's not as much money willing to kind of advance the market further. This is a very short-term indicator. And when it's extremely pessimism, you can see the average annual return is 24.5%. When it's extreme optimism, the average annual return is -3%. On a short-term basis, we've gone from extreme pessimism to extreme optimism. Now, what that says to me, since this is only short-term, that we could be due for a consolidation period. We could be due for a correction. 5 to 10% is not out of the norm at any point in time, even in a normal market, of a consolidation period. So, and that actually takes off some excessive optimism to allow the market to have a next leg up. So we are in this excessive optimism zone on a short-term basis. On a more intermediate term basis, we went from being super pessimistic in September, October, even more pessimistic than COVID, in the bottom of COVID. And that's what created this powerful rally. The expectations got very, very low. And when the expectations got very, very low, when a couple surprises came on the upside, then the market climbed this wall of worry up and up and up and up. And so we've gone from this excessive pessimism to the excessive extreme optimism, which you would think, oh no, well, that's not good. But usually the first run into extreme optimism is not a rally killer. You can see other periods of time where it can get into extreme optimism and go for a period of time. So that would still be consistent with, there could be some choppiness here in the second half, but kind of chop higher overall. And talking about expectations, so the economic sentiment is what got really, really bad. And so this is the percentage of economic surprises. So, you know, analysts, economists believe this economic number is going to come out here, and it comes out better than that. And you can see over here, the trend is, well, it started out where we weren't meeting expectations, but after the end of 2022, we started beating expectations and started beating expectations consistently. And now we're over 50%, 63% of all economic indicators that are coming out are beating economist predictions. And that's, again, why we can climb this wall of worry and continue to kind of come out of this. And so this is a good thing overall. So sentiment, a little bit of mixed bag. Macro, things are getting better. I mean, there still is, we still have kind of this interest rate credit potential to weigh in on us over the course of time. Technicals, momentum is definitely favorable right now. Valuation, mixed bag. The market's never black and white. It's always in a form of gray in one direction or another. But the takeaway is there has been alleviation of these macro headwinds. Inflation's come down considerably. The Fed is probably closer to the end. The economy's picking up a little bit, but we don't want to pick it up too much. There's been better market breadth in the last month or so that could allow for this rally to continue in the second half. We're going to have to continue to kind of thread this needle, although the hole of the needle, whatever that's called, is getting bigger between a recession and inflation risks. And we're just looking for a more broadening out of an overall rally in the second half here. So that's it. That's what I got for market outlook. I'll turn it back to you, Federico, and we can address any questions.